Calling a real estate deal good doesn't really mean much of anything, and most people that are new to this industry don't really know what a good deal actually looks like and the factors that go into rating an investment. Most real estate firms will underwrite 50 to 100 deals or more for every one deal they acquire, which means that by default, there are going to be a lot of properties that don't make the cut. And if you want to be successful in this industry, whether that's in an analyst or associate role working for an established company, or just when analyzing your own deals to add to your personal investment portfolio, you need to be able to sift through opportunities quickly to make offers and tie up deals before your competition. And especially in analytical jobs where your main responsibility is often going to be to identify value and point out the deals your company should pursue and the ones you'd recommend passing on, being able to identify a diamond in the rough is a really big part of moving up within the industry. So to help you get a general sense of some big things that you can look for when analyzing real estate deals and trying to find profitable investment opportunities, in this video, I want to talk through 3 of the most common ways that real estate investors identify value and some examples of how each of these things tend to play out in practice. So first, and probably most importantly on any deal that you're analyzing, you want to make sure that the returns that you're expecting line up with the risk that you're taking on by investing in a deal, and this is going to be measured by analyzing risk-adjusted returns. And by analyzing risk-adjusted returns, this essentially means that you're not just taking the projected returns of the deal at face value, but you're also factoring in the risk associated with the investment to determine what those returns actually should look like based on the volatility and potential downside of the deal and what the current risk-free rate of return is in the market. In a real estate context, this generally comes down to the projected internal rate of return, or IRR, on a deal, with investors looking for high-risk opportunities to also produce high IRR values, and investors generally being willing to accept lower returns for less volatile, lower-risk transactions. And on a levered basis, so factoring in debt into the projected cash flows, target IRR values usually fall somewhere between about 7% on the low end and about 20% on the high end, with high-risk speculative deals like ground-up development projects or opportunistic releasing plays usually being priced in the market based on a valuation that would allow investors to meet or exceed that 20% IRR value, and deals with a very low perceived level of risk like brand new Class A apartment buildings in heavily populated gateway metros or newly constructed office buildings occupied by national credit tenants on long-term leases, usually being priced much more competitively to get investors closer to that 7% end of the spectrum. And when I talk about deals being priced to hit a target IRR, this just means that investors will often adjust their offer prices based on a value that they believe will allow them to hit their target IRR on a deal based on their assumptions within a pro forma and the projected cash flows that those assumptions produce. This means that if you're generally pricing out deals in a specific market with a significant renovation component, for example, to hit a 14% IRR, but then all of a sudden you come across a similar deal that would produce an 18% IRR based on your assumptions, this is generally a really positive sign. And when looking for a good real estate deal, the more of a delta you can find between where a given deal falls on the risk spectrum and the returns that you can expect to generate at the price point you'll need to pay to acquire the deal, the more relative value you're likely to capture by investing in the property. Now, in addition to risk-adjusted returns, another sign of a good deal in commercial real estate is that the deal has immediate upside just by acquiring the property in the first place due to either embedded value at the time of acquisition or significant low-hanging fruit that can be implemented quickly. This can happen in a lot of different ways, but whenever investors buy a property at a price point below an amount they could immediately turn around and sell that property for in the market, This is indicative of embedded value at the time of acquisition with immediate unrealized upside for investors in the deal. This can often happen when investors find off-market opportunities with sellers that are willing to let go of their properties at below market values, but this tends to happen more frequently when investors make significant changes to operations on day one of ownership that will materially increase the net operating income of the property through things like negotiating property tax reductions or abatements with the city, or acquiring a vacant property with a tenant in tow that's ready to sign a lease immediately upon acquisition. If there's a mechanism by which the appraised value of a property can come in higher than the contracted purchase price, this is a very good sign for investors, but these opportunities do tend to be relatively rare in commercial real estate, especially as market pricing has become more efficient over time. However, finding low-hanging fruit is a much more common way for investors to quickly create value on a deal and identify profitable opportunities, and this is really just an industry buzzword that describes easily implemented changes to a property's operations that will allow an investor to quickly increase revenue or decrease expenses at a property with very little risk and or work associated with those changes. These types of scenarios often come up when there are in-place tenants at a commercial property that are paying rent at significantly below market rates, and the new owner could either raise rates for the existing tenant when the lease expires or re-lease the space to a new tenant at that time, but this can also occur with less obvious adjustments like adding washer and dryer appliances to multifamily units for a significant monthly rent increase. Or this could just be something as simple as better expense management overall and being able to renegotiate contract expenses, reduce insurance premiums, or cut unnecessary payroll costs to increase NOI. The goal here is to find a deal with either embedded value at the time of acquisition that creates an immediate gap between the price an investor pays and the market value of a property, or to find a deal with material low-hanging fruit that creates a very clear and low-risk path to increasing NOI and subsequently property value. Now finally, let's round this video out with a characteristic of a good real estate deal that is especially relevant in today's market, and this is the downside protection that the property offers. Good examples of deals with downside protection are affordable housing properties where rents are significantly below market due to rent restrictions, but rents are guaranteed by government entities and paid directly on behalf of the tenant. Very well located properties in markets with strong supply and demand fundamentals also generally have significant downside protection with tight occupancy levels and minimal incoming supply, often indicating that a property could be re-leased quickly if a tenant were to vacate, often at higher rates than the previous tenant was paying. Even a single tenant property with a credit tenant in place under a long-term lease with an absolute net reimbursement structure can offer significant downside protection to an investor, making the tenant responsible for all maintenance as well as any damage to the structure of the building itself that might be incurred during an investor's ownership. Just like the famous rules of investing by Warren Buffett go, rule number 1 is to not lose money, and rule number 2 is to see rule number 1 and deals that are unlikely to see big drops in net operating income, whether that's through a diverse tenant base, a strong tenant credit profile, a growing and supply-constrained market, or even rents that are paid directly by the government, tend to be some of the most likely deals to preserve and grow their value even during tough times. Now, this is obviously by no means a comprehensive list, and there are so many ways to create and find value in commercial real estate, but if you're working as an analyst or associate and you're being tasked with screening investment opportunities and only presenting those that you'd recommend adding to your company's portfolio, these are 3 ways you can narrow down that search and maximize your chances of finding profitable deals. And if you want to learn more about the real estate investment analysis process and you want to take a deeper dive into commercial real estate valuation and financial modeling, including how to build out a real estate pro forma model from scratch in Excel, as always, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on this channel on deal analysis and valuation techniques, make sure to hit the like button and let me know. And let me know in the comments any other things you look for to spot opportunities when underwriting deals. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.